Welcome to another episode of Financial Minds. Today we will explore the trends shaping the financial world and how they impact the credit union movement. With the next Federal Reserve meeting right around the corner, we're diving into what really is happening in the economy and what the Fed might do next and what all that means for credit unions. Joining me today for the discussion are Tim Sustak, our SVP Chief Treasury Officer, and Scott Wood, our SVP Chief Investment Officer with Vizo Financial. So let's start by taking the economic pulse before we get into policy and strategy. So Tim, I'm going to start with you. How would you describe the current state of the U.S. economy heading into the Fed meeting?
Well, that's a really good question, Jamie. And we can't detect a pulse because the little meter has shut down. The batteries are dead. We all know the government shut down on October 1st, so we're not getting any data, at least any government-produced data. There's still some private stuff out there, but I think the government data is what everybody relies upon. That being said, the BLS, Bureau of Labor Statistics, did come out and say that although the CPI report is going to be late, they are bringing some staff in to get that completed, and they'll have that out on October 24th. So we still will get a CPI, albeit about a week and a half late, I guess. And so that's good. So we'll have something there. Before the shutdown, I think the way I see it is, spending seemed to be progressing well. Growth was still good. Inflation stable, maybe ticking up a little bit. And still some concern around the labor market, obviously. And I don't know that a lot of that has really changed since then, at least with what we know, right? Fed came out with a beige book, which is their report about every 6 or so weeks that qualitative information observed from the 12 Federal Reserve districts and the connections that they have, and they discuss the economy and see what's going on. I mean, kind of an overall view there, growth little change, labor markets largely stable, demand muted, prices maybe ticking up a little bit. A lot said that's kind of tariff related. I think businesses are still trying to figure out, how much they can get away with passing through to the consumer, how much kind of they have to deal with themselves because they don't have that ability to pass through those increases. But, I think overall, not a ton of change from when we were getting statistics, probably. I think, one thing that's kind of interesting is this thought of a kind of the bifurcated economy, right? And we've seen that ever since the recovery from the Great Recession. People talking about kind of that K-shaped recovery, and we hear about the haves and have-nots, and that chasm's kind of growing wider. And one article I found interesting that I read the other day talked about the fact that that chasm is getting so wider, and that at some point maybe the folks that are able to propel the economy forward, that are doing well, start to negate really what's happening with the folks that are the have-nots. And that's sad to say, but at least from a statistical perspective, I think there's some evidence to start to say that, well, that's starting to mean less because the haves are able to drive the economy. They're able to drive spending. Now, we still see some of those concerns around delinquencies and debt usage and things like that. But it's just a very interesting time, I think. And we see that in what's going on with the economy currently. We see that with the Fed's mandate intention, as they say, where you've got a labor market that seems like it could be faltering and you need rate cuts, but then you've got inflation that's kind of hung around for a while, and then maybe some tariff impacts there that made an increase. So it's definitely a very interesting time, and not the best time to be without data. But we'll see how that keeps moving and how fast we can get the government back up and running.
Yeah. So Scott, that kind of leads me into my next question. So, given the data we do have on inflation, unemployment, and GDP, what do you see as the most likely path for the Fed's decision at the upcoming meeting?
Yeah, I think Tim summed up the lack of data well, right? The federal government has been shut down for, basically 3 weeks now. So we're missing a lot of data. So we're going based on what we know before, what we can kind of see. Is there big changes in the last, let's call it 3 weeks since the government shut down? Probably not. So based on that, we think the Fed will probably continue on their current trajectory. Based on that, and based on some of the comments we've heard from Fed officials, there's still a pretty good split at the Fed, right? There's a group over there that thinks inflation is a primary concern or should be. And then there's a slightly larger group that thinks that the Fed should be cutting rates. They don't necessarily disagree that inflation could be a concern, but they think the prudent course of action today is to cut rates. So very likely we're going to see another rate cut at the October meeting. And more than likely we'll see one in December too. They have a mid-December meeting or early to mid-December meeting. So we're likely going to get two more rate cuts this year of 25 basis points each. The real issue is going to be once the data starts flowing again, what does it look like? And then also as we get into next year, do we have more pushback from those folks that think inflation uh, is the primary concern? As Tim mentioned, inflation had been coming down. I think it hit its low in the middle of the year, maybe early summer. And then for the last 2 to 3 months, when you look at CPI anyway on the core reading, it's ticked up a little bit. That would become problematic if that continues, right? If we start to see inflation continuing higher, and then we see continued weakness in the employment report, then those two things together are going to create an issue for the Fed, and then it's going to be who wins that argument. Right now, it's the folks that are in the cut rate camp. So just to sum it up with my rambling, two rate cuts this year, one at each of the next two meetings, 25 basis points each. And then next year, we'll have to see if we get further rate cuts or not next year. And really, that's going to be data driven, I think, more data driven.
All right. So then, Tim, what are the risks or the surprises that could sway the Fed towards a more hawkish or dovish stance?
Yeah, good question. I mean, I think we could talk about that for a while. There's a lot of surprises that could happen that we don't know anything about yet, right? That's why there's surprises. But I mean, look, we talked about the dual mandate being intention. I think certainly if you'd look at what would drive them a bit more hawkish, obviously that'd be inflation, right? As Scott said, inflation. If that continues to tick up, and I think right now, I mean, tariffs are probably at least the most obvious thing that's everybody's watching there, right? And just the other day, China, I'm sure everybody's heard about the rare earths conundrum and their thought about restrictions there. And of course, everybody needs rare earths for tech and other manufacturing. And of course, the United States came out in response to that and said, hey, well, we might just jack up tariffs to 100%, right? So these type of things are always kind of ebbing and flowing, and I think how's that going to flesh out? We don't know. I think I saw Treasury Secretary Bessent is going to be talking to his counterpart in China to try and work through some things. So I mean, you just never know how these situations are going to work out, and we've kind of thrown that tariff card on the deck, so to speak. So it's a really active playing field with that right now. Anytime we see something that is going on that we don't necessarily like. So certainly, those are things to watch. Obviously, on the dovish side, everybody's watching the jobs data, right? And, I read an interesting article just this morning about small business. And, they say, about 40% of GDP is in small businesses and employ about half of the workers in the economy. And it was a very interesting article about, how tariffs hit different companies different, right? The larger ones can pull a lot more levers. They have a lot more bargaining power, more access to liquidity and things like that. And they were just talking about some of these small businesses that, hey, had to take a, $250,000 loan off to pay my tariff bill so I could get inventory to sell during the holiday season. I've never had to do that before, and if my sales don't go well, I don't know what I'm going to do. Or, I typically just tap a line of credit to buy inventory, but now I've had to tap more because of the tariff cost, and I may have to lay off some people now because of that, and what have you. So I think there's a lot in play there, and small businesses are hurt the worst. So we certainly could see some backup in the labor market there. Um, you know, wars out there, obviously, continue to go on. Russia, anything could happen there, right? That could certainly affect, um, what we do with, placing certain restrictions on goods or other things that could hurt supply chains or the economy. And I think, when you look at what some of the Fed speak has been lately, and I kind of found it interesting. I mean, based on what Chair Powell said his latest speech that he gave, he said, "Hey, look, not a whole lot's changed. To Scott's point, labor market hasn't changed. Certainly, kind of seemed that a go with continued rate decrease. I think the 25 basis point increase. I certainly agree with Scott at the October meeting is pretty much a foregone conclusion. But I thought, Christopher Waller on the Federal Reserve Board, his latest comments were very interesting because he's one that is certainly a strong contender for the chairmanship when Chair Powell his term comes to an end next year. And, he's been one that's really been beating the drum about caution with what's going on in the labor market. And even when we weren't cutting, he was one that was saying, hey, we should be cutting rates. The labor market's starting to falter. His most recent comments, he's certainly still advocating for the 25 basis points in October, but seemed less convinced after that. Really started talking about, hey, we really have to see how the data looks. We have to see how this intention mandate kind of plays itself out. And he was much less, he seemed anyway, much less committed to saying that, hey, yeah, this, reduction in rates is going to be a kind of a foregone conclusion after October, and much more on the side of, hey, we have to be cautious. Let's do 25 and see what happens, and we'll go from there. So, I just look at it and say, I wonder, we'll see, as Scott said, we'll see what happens when the data comes back out, but I don't know that after October that it's just a complete foregone conclusion. It'll be interesting to watch.
Okay. All right. So, Scott, if the Fed cuts rates as you're predicting, what opportunities or challenges could emerge for credit unions?
Yeah, so I guess there are some opportunities. So, rates have been heading lower, right, in anticipation. Either the Fed did do their cut in September, rates have been falling across the curve for the most part, although what we've seen is a bit of a bull steepener. Meaning the shorter end, which the Fed controls through rate cuts, and generally speaking, that's overnight through about 2 years. That's what the Fed kind of controls by adjusting the overnight rate, Fed funds. So those rates have been coming down at a faster pace than the longer end of the curve, and especially if you look at like the 10-year treasury, which, it's when on days when the markets drop rates, the 10-year has been, generally speaking, dropping less. And the days that the market is up on the yields are up, it usually goes up a little bit more than the shorter end. So a little bit of a bull steepener. So it creates some potential issues or opportunities for credit unions. If we see this continue, if we see shorter rates continuing to drop a little bit faster, there'll be opportunities on shorter type of loans, things like auto lending, and other short-term loans, that members may take out for, 2 to 5 years or so, somewhere in that range. The issue arises, and this has been a challenge for credit unions for a number of years now, has been on the mortgage side of things, right? There hasn't been a whole lot of activity since the Fed, since rates went up a couple of years ago, pretty high, above 7%. We've seen a real slowdown in real estate activity in general. The bright spot really has been on new homes, right? And that's been because the builders have been able to incentivize the buyers. They can help them buy down the mortgage and things like that, the mortgage rate. We don't see that so much with normal sales that aren't new homes. So that's going to be a continued issue probably for credit unions unless, and banks too, I mean, any financial institution, unless we see the curve fall enough where we get, the 10-year where we can, sub 5%, or excuse me, sub 4%, where we can get mortgages in that 5 to 6% range. That's going to be a challenge. It's going to have to come down, probably if we get below that 6% range in mortgages, which would be sub 4% in the 10-year treasury to get there. Then they may see some activity happening, but it's going to be more challenging. So the focus probably is going to be for a while is going to be on the shorter end with auto type of loans and things like that. Net interest margin is probably going to compress. This is the big challenge too for credit unions, is where to set their deposit rates as rates are heading lower. How quickly can they adjust? Are they going to see a runoff in deposits if they adjust too quickly or by too much? So credit unions tend to not move super fast on the way down. Like with that, um, on the deposit side, the issue is going to be on the lending side. Are they quick enough to adjust those rates? And we can remember from a few years ago when auto rates were were super low at credit unions. They were getting a big share of the auto loan business, but it was probably because in some cases the markets felt like, and others that maybe credit unions were a little mispriced. And that's the eternal battle between your CFO and your CLO, right? Where should we set these rates? Because one is more looking at income and future issues down the road with interest rate, while one is like, we want to crank out these loans and continue serving our members, right? So you have these things that are fighting against one another. But I think the opportunities for credit unions are going to be on the shorter end of loans initially. It would be great if we got to see some mortgages getting below 6%, because we think if you get into that 5.50 or 6% range, we could see a bit of a wave of refinancing, that would be nice for the bottom line of credit unions if those loans were priced properly and things. I think the risk is kind of what Tim alluded to a moment ago, is there is a lot of uncertainty going forward with rates. I think we're going to get two more this year, and then the uncertainty with rate cuts comes in. But there's a lot of uncertainty as we head into next year on where rates are heading, where the economy is heading. He talked about the higher income folks that are still spending money, and they're pretty well. The folks that are lower income, the month, paycheck to paycheck type of people, the struggle continues, right? It hasn't improved because while certainly the pace of inflation has slowed, we haven't had deflation. So they're still dealing with those rate increases over the last few years, plus continued, let's say around 3% overall for a basket of goods. And for some of these people, recent college graduates, they have student loans that have kicked in. For everybody, they've had student loan payments that have kicked back in. And surprisingly, it's not always recent college graduates. A lot of these student loans are paid by people in Gen X, my age group, right? They're paying for their children's college education. They're paying for those loans. So some of them are struggling. So, and I saw a thing today or recently on Bloomberg where they were talking about there was a recent study done on auto lending. Auto delinquencies over the last 15 years have increased. Delinquencies have increased by 50% over the last 15 years, right? So we're all fighting this higher car payments, higher loan rates, longer terms. We have these other issues out there. And they said, surprisingly, over the last 3 years, what the study found was prime and near prime borrowers, their payments have been worse than the lower credit tiers over the last 3 years. So everybody's getting stretched. The higher incomes have been keeping the economy alive, but I think, like Tim, I have a little bit of a concern. Should that spending slow? It's kind of muddying up the data, but should it slow? What's the impact going to be overall in the economy? Because they have been keeping it kind of running. GDP has been pretty strong, right? The first quarter was negative, but we had a really strong 3.8% in the second quarter. The Atlanta Fed projections are 3.8 in the third quarter. So we project pretty strong GDP, but there's still a lot of other factors that make it challenging. So these things, obviously could have an impact on credit unions' profitability, because while delinquencies peaked earlier this year and they've been improving since then, there is a real concern that they could again pick up and create issues as we head into 2026. So those are things that all are weighing on a credit union and their decisions, and they could have an impact on profitability.
Yeah. Well, then, Tim, let's look at the opposite side. So conversely, if the Fed holds rates longer, what could that mean for credit unions?
Well, I think a lot of what Scott talked about kind of bleeds in, right? What he was talking about here at the end. Yeah, I agree. I mean, if you get the folks that are spending and driving the economy forward, if we get to a point where they're struggling and that stops, it could lead to a fairly significant downturn. And the longer we see rates elevated, and to Scott's point, you know, people getting pushed on various loans that they have, as well as prices for food and everything that are high and rising. You know, probably the better chances are we could see something like that, you know, get to that point. Hopefully that doesn't happen. Um, you know, but if rates are higher for longer, I think, you know, first thing, credit unions, it seems to be very much of a mixed bag of what's going on with them right now. I mean, as Scott and I talk with credit unions, others at Vizo talk with credit unions, it is really a mixed bag as far as, you know, some are having trouble retaining deposits and they're flowing out. Some have all the deposits they need. They're very stable. Some are having trouble making loans. Some are not. It's very a very interesting time right now. You know, not only from a liquidity perspective and you know how eerily stable that's been, but also just from you know there's a lot of different stories going on with credit unions right now. I think overall you'd see obviously you know cost of funds would remain up. You can still find online accounts out there that are paying upper fours. If rates persist high, you're still going to see that fight for deposits. Credit unions will have to make sure they're paying well enough to keep the liquidity they need, to keep the deposits they need. Um, I think though you might not see the margin compression you would see as rates fall. I mean, you can only certainly as rates fall, you can only lower those deposit rates so much, especially some of them that are still not super high. So you may not see the compression that you would see if rates fall, and you may still have some investment opportunities, right? I mean, it's still if rates remain where they are, I think eventually, you know, over time, we're certainly going to see them back up. You know, you still may have some time if you have liquidity to take advantage of rates while they are still high. You know, from the loan side, you know, just like Scott said, I think, you know, if rates persist high, you're going to see things remain muted, particularly in the mortgage market. Although we have had credit unions that are having success in HELOCs, although mortgages aren't doing well, as people stay at homes and use that equity in their home to you know, improve the home or use it for other things. So I think in general, that's what we might see happen. But as Scott said, I think there's a lot of uncertainty going forward. So that's my thought is, you know, don't put all your eggs in one basket or the other. Make sure you're running a model and taking a look at options you'd have, whether rates are going to stay where they're at for a while longer, or whether we're going to see that kind of continued decline that a lot are predicting.
I was waiting for one of you to use the word uncertainty. So that has been your word this year. So Tim, you went ahead and used it again. So just a lot of uncertainty. So Scott, I'm going to come back to you. You kind of talked a little bit about some of the trends, but you know, what trends are you observing, you know, in member or consumer behavior in regards to savings, borrowing? You already kind of talked about delinquency a little bit. You know, that, you know, what are all these things? How do they reflect the broader economic pressures that we're experiencing?
Yeah, so it's really interesting. Tim and I have had it in our internal ALCO that when we meet and stuff, and then separately, Tim and I, we've had these discussions a lot recently as we talk to members, as we go to these different meetings, our financial conference and and other regional meetings, and just one-on-one conversations. It's a really interesting time. It's a really contradictory or mixed bag time. It seems like almost every credit union is in a different situation. And we generally do not see this, right? We generally, that 80-20% rule, 80-20 rule, it applies big time to credit unions normally. And normally I would say it even goes as high as 90-10 or 95-5. I mean, it's like almost always credit unions are kind of, they're here together or else they're here together and they're moving in the same direction. Right now, or for the last few months, we have seen a big difference at credit unions. I was talking to one credit union maybe a few months ago, back in April or May. They had their best first mortgage month ever in their history. The number of first mortgages that they were able to generate, which was really contradictory because mortgage rates were really high at the time, but they had their best month ever on fixed rate mortgages. Um, we talked to some that are really doing well with autos, and we have some that are struggling with all loan types. We have some that have shares running off. We have some that are shares are holding up. It literally is all over the board. And we think maybe there's a little bit of a regional um, consensus. Like, you know, maybe if you look up in the mid-Atlantic area, there's a little bit more savings going on by credit union members. but also if you look historically at the Rust Belt states, they historically borrow less money. I mean, and they have better payment, less delinquencies. There are these regional things like that, right? That we see. But overall, credit unions, they seem to be all over the board and it's really hard to get a consensus. So what it tells me is that we're probably at a turning point. And I don't know if that's which direction we're going to head. As the Fed is fairly evenly split, I would say that I feel the same split internally with myself. And Tim probably is in the same situation where you could make the case on either direction easily. The economy is going to do really well next year, or we're going to struggle next year, right? We've got potential additional tax cuts coming for some people, like no taxes on tips, and which is really less taxes on tips up to a certain level, less taxes on Social Security up to a certain level. So some of these people, some of these folks that this applies to are going to have more money next year when they get their tax return. It may be a little bit better return than normal or less money owed. So some people are going to be a little bit better off. Most of it is the tax cuts are the same as they were before. It's just going to make, technically they're called permanent now. They're not temporary, but Congress they can change anything. So nothing's really permanent. But um, so those impacts there. When you look outside of credit union land and just look at the data that we get, and again, the data is somewhat limited now because we're not getting government data. But when you look at the data, it's mixed too. It's very interesting. So if you look at credit card and debit card usage data, which generally a lot of us are cash free, right? We use debit and credit cards for most of our purchases. Well, guess what? Over the last 2 or 3 months, we've seen a drop in the amount of money that's been charged or taken out of somebody's checking account through debit cards or credit cards. But on the flip side, when you look at retail sales and what's going on at same source store sales, have held up steadily. There's been no drop off there. So how do you explain that? You could say that people are using cash more. I don't know if I would say that because I use cash occasionally, but it's so much easier to use the card, whether it's your credit or debit card, any card, just to throw it on the machine and you tap it and you're out of there. Um, so I don't know what explains that difference. Because like I said, you could say it's cash, but I don't think that's what it is. There's something else at play there. But that's what we're seeing in the data. There's a lot of contradictory data that doesn't align. We should see some alignment, but we're not seeing it. So, are we seeing slight slowdowns in things? I've heard, read that restaurant sales have been slowing down a little bit, but then I also read that we're more money is spent on restaurant sales now than ever, and a lot of it is driven by these people younger than me that do like the delivery meal service and either mail order stuff that comes in that's prepared and you just kind of heat it up kind of thing, or you could cook it, chop it up and cook it, or just the StubHub type of stuff that their favorite restaurant is being delivered to them. So contradictory data. The more data we get, I think the better off we're going to be. So hopefully we just have to keep looking at the data. And unfortunately, right now, it may be a credit union by credit union. What are my members doing? As my big employer seg groups, are they still employing people, paying well? Then people are probably going to continue to spend. And I think overall things look pretty good, especially if you look at GDP, but there are some signs of potential, slowdown if they continue.
All right. Well, do either of you have any final thoughts for our listeners today?
That's tough. I don't know how much more there is to say. I think for me, it's just, and I think we all learned this right after last time, the Fed told us slow on rates, and then we got 500 basis points in 15 months, right? You never know what's going to happen, to Scott's point. You got to, watch the data, it'll come back. We'll start to see more data and we'll see where this thing goes. But I don't think you can be married to any one outcome because, as Scott said, going into next year, it's too unknown. You have to be prepared for either, rates remaining up or, rates backing off. I mean, I think, what 275 to 3 is what a lot of them are saying is maybe neutral. So, we'll see.
All right.
Yeah, the neutral rate obviously comes into play here. 275 to 3. I've heard some lately saying that it's probably higher than that. Maybe it's 325 to 350. So there's even debate amongst the economists on that. What is the real neutral rate? Where does the Fed get to? Yeah, I will say this about me personally. I'm very optimistic generally about the economy, and I still am. There's a lot of things out there that um, signs to be aware of and keep an eye on. But overall, again, I'm positive about the economy. I think we're heading in the right direction, but there are so many things. The U.S. economy alone is very sophisticated, right? And broad. There's a lot going on out there. But then when you tie it in the fact that we're all tied together globally, and Tim talked about tariffs, there's a lot of potential issues out there. I think calmer heads prevail. We look like we're getting peace in the Middle East. It seems like that. We're early on in this, I think it's like a 20-step program, and we're maybe at step 3. So there's a lot of steps to go. There's hope that this Russia-Ukraine thing might be resolved too. If those things actually get resolved and play out, and we can take those global conflicts off the table, it certainly helps things. But there still are tariff barriers to work through. We still have to find out if they're even right. The Supreme Court to determine if they're even legal, and then if there's money to be paid back. So there's a lot going on out there. But I think the American consumer time and again proves to be pretty resilient. So even if we do hit a bit of a downturn, I think we'll get out of it relatively quickly. But again, you have to be aware of all these black swans, and there are plenty of them out there to be aware of.
All right. As always, great discussion, and I thank you both for joining me today. Don't forget to subscribe, share your thoughts, and also stay tuned for Vizo Financial's post-Fed meeting analysis with Tim's FOMC update. Special thanks to Vizo Financial's Payment Conference for sponsoring today's episode. Join us for Vizo Financial's 2025 Virtual Payments Conference, which is an immersive online event on November 5th and the 6th that will unite credit union professionals and payment industry leaders for an in-depth exploration of evolving payments landscapes. This year's agenda is packed with essential sessions focused on the most critical payment issues and advancements facing today's payments world. Learn how to conduct comprehensive risk evaluations to ensure compliance and operational security, explore the latest tools to combat emerging threats, stay ahead of shifting regulatory requirements and industry standards. This virtual conference will offer your credit union actionable insights to ensure your institution is ready for the future of payments. Register today at www.vfccu.org. As always, thanks for listening and make it a great day.